India Equity Research and Equity Strategies with Morgan Stanley now joins us. Ridham, good morning. Thank you for joining us. What should we expect tomorrow from a market standpoint? More like a 100-point Nifty swing and it will be back to basics, or tomorrow's budget in the current global context could be of a meaningful difference?
Nikunj, I have no idea what the market will do on a daily basis. It's very hard to say. But I think we're looking at a budget in which, the finance minister has already informed us that the glide path for the fiscal deficit will shift slightly. So I think the type of fiscal consolidation that we've seen over the past 3 years may take a bit of a pause. I would guess that that's already priced in because market participants have already been informed about this in advance. So unless there's a very large fiscal slippage, it should not surprise the market. I would keenly watch for expenditure growth. The trailing 12-month expenditure growth is it's actually high single digits, around 9%. I think that would accelerate next year to maybe 15%, and that's going to form a big support for the economy in 2018. And I think he'll back it up with asset sales. So they've talked about enemy property sales. There will be probably a big divestment target. There's also going to be some acceleration in revenue growth because if the economy picks up, then revenues will also pick up. I think GST will stabilize and therefore GST revenues will also pick up. So all in all, I think it'll be a fairly stimulative budget with focus on infrastructure and likely focus on rural India, especially rural infrastructure like electricity, roads, irrigation. Direct benefits transfer, I think, should get a big mention. Housing should probably get a big mention. So all in all, a pretty stimulative budget for growth. And therefore growth, which in my view turned end of last year or probably in the fourth quarter of last year, I think will continue to accelerate. And we are seeing that in the earnings season. It's a pretty robust earnings season thus far, mid-teen growth rate that we're seeing in earnings. And probably that number accelerates as 2018 progresses.
All that the markets are fearing right now is whether or not there is going to be a long-term capital gains tax in any form. Do you think if that were to be the case come tomorrow, are we in for a rude shock, or do you think somewhere the market is already bracing itself with it? At least that's what some of the mid-cap and small-cap sell-off seems to be indicating, that somewhere the market is preparing itself for maybe a move like this.
My comment would be that I think the market is prepared for a change in the holding period. So, as you know, right now, you hold shares for 1 year, they become eligible for long-term capital gains, which is basically 0%. Maybe that gets, into a 2-year holding period. And that, I think, is probably priced in. I don't think, per se, a long-term capital gains tax is priced in. So I don't think the market believes that the government will reintroduce long-term capital gains tax, say, at the rate of 20%. And the worst case scenario for the market is both of these happen, which is the holding period is extended and the long-term capital gains tax is extended. Now, you could debate on both sides, and frankly, I think this is a 50-50 call. Very hard to actually say whether it will happen or not. But on one hand, the government has probably got a large amount of asset sales to undertake this year, and therefore buoyant share prices will augur well for their expenditure targets. On the other hand, I think, as you've seen in the economic survey, the chief economic advisor has cautioned us against a building bubble in share prices. So I think it's a 50-50, but more likely, if I were to make a call here, I think the likelihood is that the period for holding shares to be eligible for long-term capital gains is going to get extended from, say, 1 to 2 years. That's, I think, the more likely outcome rather than tax. But if tax comes, then I think you will see a volatile reaction from shares, at least in the short run.
Placing your bets on just the holding period adjustment, you're saying from 1 year to 2 years, the market will not really budge that much, and it will not call for an exaggerated reaction. Is that right?
Yeah, I think so. That's what my opinion would be, that I think the market has probably priced that in. I think it is It's been discussed quite a lot over the past few days, and things which get discussed this often, usually get priced in. So that should be priced in.
What about corporate tax? Now the glide path was given, but no action has been taken. We know the global mood, and the global mood is that there are tax cuts which have been announced. And if tax cuts have been announced by the American administration, other countries will have to do something in align to, remain or stay competitive. So do you think it is imperative that a corporate tax cut of 2 to 2.5% should come?
It's a possibility, Nikunj, but I wouldn't hold my breath for that, because it's a year in which I think the government's focus will be on enhancing expenditure rather than stimulating the economy through tax cuts. Mind you, they've already done a fair bit on GST, well ahead of expectations. We've had 3 rounds of GST rate cuts, and 6 months ago, I don't think people would have expected such outcomes by January of 2018. So they're focusing on realigning and rejigging indirect taxes. So I think direct taxes, a big cut will probably have to wait for the direct tax score, which is right now being authored, and maybe it's ready next year, and it'll be the next government's task to take that. So maybe a token cut of 1%. I wouldn't expect a major change in direct taxes at any level. There's another debate, of course, which is on dividend distribution tax. And I think there are some representations made to the government that there's double taxation on dividends now, because people receiving more than ₹1 million of dividends today pay marginal rate of tax on dividends, which is in addition to the 20% that corporates cut in form of dividend tax. So there is 2 levels of taxation, and maybe there's some view to change that and remove dividend distribution tax. Again, I don't see this as a game changer. When the finance minister introduced this extra tax on dividends last year, nobody forecasted that companies would respond with buybacks. In the trailing 12 months, we've had $8 billion of corporate buybacks. And amongst the other things that have been driving demand supply for equities, this has also played a role. It's not a small amount. $8 billion is almost equal to 50% of all mutual fund buying last year. So it's a pretty large amount of buying that corporates are doing to save the controlling stakeholders from paying dividend tax. So if they remove dividend distribution tax and make dividends fully taxed at the hands of the recipient, then probably buybacks will go up slightly. So net, I think it'll be neutral for the market. But that's the other debate around direct taxes. But to answer your question, I expect minimal changes to direct taxes in this budget.
Ridham, good morning. The street pretty much has been talking about infrastructure spending as well as boosting rural demand as the 2 focal themes for this government's budget this time around. What do you expect specifically on both those accounts, particularly on the rural economy side? Because I was making the point a few days back about how wage inflation has actually on average has grown 5% over the last few years, which is not even beating inflation. So there is tremendous scope of actually boosting consumption there and spurring demand.
Yeah, so Tanvir, I think this government's approach has been very different. Unlike past governments in India, which have doled out cash to poor people, and as we have seen in the last experiment, doling out cash created inflation. This government has focused on building assets, and I think that's a very different approach, and it's a very good long-term approach, because after you're done with it, you actually leave behind wealth on the balance sheets of poor people. So it actually creates a transfer of wealth rather than just a transfer of income. So I don't see major deviation from that theme. So think about rural asset creation as the key focus here. And the big announcement that I'm expecting is last mile access for electricity. So they have already brought electricity to bulk of India's 600,000 villages over the past 3.5 years. But that electricity has not necessarily reached the homes of every single villager. And that's an onerous task. It's a very tough thing to do. And I think that's what they're going to attempt to do. So they'll probably focus on bringing that electricity into the homes. And if they were to do that across, say, 80, 90,000 villages over the course of the next 12 months, I think that will be a great achievement. But that would be one big announcement I'm expecting in the budget. The other thing would be on rural roads. I think road connectivity in rural India will play a big role in transferring wealth and income to rural India and in creating jobs as well, especially for the unskilled laborers who are leaving farmlands and looking for jobs in urban India. So I would expect a pretty big jump in rural road spending. There's already a scheme out there, the Pradhan Mantri Gram Sadak Yojana, and I think we should see some big focus on that. I don't expect major focus, increased focus on irrigation. This has been one of the things that they've been spending money on. Maybe micro irrigation occupies more attention. But the other big thing that will get discussed, I think, is DBT for fertilizers. The pilot projects are done, they've been successful, and I think this has great potential in transferring money into the hands of poor farmers, which hitherto was probably eaten away by middlemen and did not efficiently transfer to poor people. So DBT for fertilizers could be a big thing. Manrega, I think spending will probably rise in line with GDP, so no acceleration there, because again, transferring income can prove to be inflationary, especially in a year in which I think government expenditure is going up and the headwinds for inflation are converting into tailwinds. So you don't want to put more pressure on inflation by transferring incomes directly through Manrega. So I think more on building rural assets rather than social giveaways. That should be the theme of the budget.
The other key talking point is inflation. And now I know that, in your own understanding, you believe that the impact on inflation outlook will be muted. But this is not just a local issue, it's also a global issue, given what one is expecting as far as the trends go on core inflation and what's happening with oil prices. Back home, it will be a mix of what the government's policy to manage inflation would be versus the RBI's. How do you look at inflation being tackled, if at all it's a risk for the rest of the year?
Well, it is a risk. It's emerging risk. We've had this view that inflation bottomed last year and that it's nudging higher, probably in the 5 handle this year. And to that extent, we also have opined at the end of last year that the rate cycle in India is over. And there's a chance that in the second half of this year, we may actually begin to see tightening. I think the approach of the central bank is pretty clear. Their framework is well laid out. They will pursue positive real rates to keep the lid on inflation. And they've also guided us on the range that they're going to pursue, which is, say, around 100 to 150 basis points of real rates. So they'll react to inflationary pressures by lifting interest rates, and it's quite possible that they do that in the second half this year. From the government perspective, I think the key is to keep expenditure on non-productive items in control, and to keep the overall fiscal deficit in check. And I expect both these outcomes in this budget. So I don't, as I just outlined a while back, expect the government to pursue non-productive expenditure. They'll focus more on building assets than transferring incomes. And I think they are probably going to keep the fiscal deficit around these levels. We will not get the same rate of consolidation that we've seen in the last 3 years, but I think it's unlikely that the finance minister lets the fiscal deficit estimates climb from here. So I think that's the way they'll do their contribution. Oil is certainly a joker in the pack. And if oil continues to rise, then the impact on India will be a little different from the past. So let me just spend a moment here. In the past, a sudden rise in oil prices, especially when it was supply shock led, created a currency market problem, which then transferred to as inflation and caused rates to rise and growth to slow down. So that was the transmission channel for oil. This time I expect oil to transmit slightly differently, because India is firmly in a BOP surplus, and therefore I don't expect oil price rise to immediately affect the currency. Instead, I think the government may end up cutting taxes in order to protect the consumer from the oil price rise. Remember, they raised taxes when oil prices were falling, so they have a pretty good cushion there to cut taxes to protect the consumer from oil price rises. But the minute you start cutting taxes, it puts strain on the fisc, and it will compromise the government's ability to undertake other expenditure, and that will then hit growth. So the transmission effect of oil, I think, will be a little different from the past, because India's macro stability is in very good shape with positive real rates, with a declining fisc and a positive BOP. So I expect the transmission impact to happen in the form of slower growth if oil continues to rise, but I think that's a joker in the pack and should be watched very carefully.
Ridham, the economy is on a mend. Globally, things are looking up. So I expect that the finance minister would have optimistic assumptions for revenue and growth for the coming fiscal year. What, to your mind, in the current global and local backdrop, would be a optimistic and a realistic assumption?
So I think, again, I'll draw a reference to the economic survey, which makes a good point on the multiplier of GST. So, contrary to the popular perception, GST has led to higher compliance, and therefore growth rate in tax collection is exceeding nominal GDP. So ordinarily, when GDP growth is slowing down, the multiplier tends to fall. And we've seen over the past few years, it's fallen to say 0.8, 0.9. And just to clarify, what I mean is that if nominal GDP growth is 11% and slowing, tax revenue growth tends to be say 10 or 9. But when GDP growth starts accelerating, as we think it will in 2018, that multiplier also actually starts rising. So there's a non-linear relationship between GDP growth and tax collection. So ordinarily, if GDP growth is improving this year, and say it's going from 11 to 12, then tax collection growth could rise from say 10% to 13%. So that multiplier has gone up. On top of it, you have a structural factor like GST, which is coming in play. So I think depending on what the nominal growth forecast is, and assuming say it's 11%, I won't be surprised if the tax revenue collection assumption is at 13 or 14%. And that would probably be a reasonable assumption for the finance minister to make in the context of what I just said.
The success story, Ridham, really has been the disinvestment, and again, good quality government paper, whether it is a innovative way of raising money via the ETF route or taking some general insurance and insurance companies public. So do you think disinvestment assumptions of 1 lakh crore plus or a number around 1 lakh crore is coming for next year?
Yeah, it's quite possible, Nikunj, that they have a pretty aggressive number. Given the success they've had this trailing 12 months, which has exceeded my expectations, because I recall that in my post-budget interview to you, I had expressed skepticism about the aggressive disinvestment target. And I said that was the one flaw in the budget numbers. And I've been proved wrong, because they have managed to exceed that target pretty well and in advance. And by the way, if you look at the historical track record of government in India, it's very rare for them to exceed their divestment target. I think you have to go all the way back to 2001, 2002, when I think Mr. Arun Shourie was the divestment minister. And after that, they have successively missed targets. So clearly they have beaten expectations. Certainly they have surprised me on the upside. So I think given the tailwind of success of the last 12 months, it's a fair assumption to make that this year they will go for a big number. And that will be needed for them to balance the budget, because if you are targeting acceleration in expenditure growth and you don't want to be too optimistic about revenue collection and you want to have a conservative number there, then the way you balance this is by pursuing asset sales. So I think that's par for the course. And just, if I may spend another moment on this, it actually circles back to demand supply for equities, which is last year, the net demand supply was extremely favorable for stocks because there was a limited supply. Of course, supply did rise and it ended the year at about $28 billion, and it jumped up considerably from the previous year. But this year, I'm sensing that supply is going to go up even more and probably end up in the $40 billion mark, which then I think will start putting pressure on that demand-supply equation. So that is one drag on share prices. To some extent, I think mid-caps are responding to that drag because they are expecting more supply and from the government as well as from the private sector. So that I think is something that we need to keep an eye on.
So as an investor, Ridham, when you've already made 40% returns on the Nifty last year, over 40 when it came to the broader markets, and irrespective of this recent correction that we are beginning to see in the broader markets, what is it that you do? Do you wait for that big impending correction that everyone's talking about, which could be perhaps led by something globally? And maybe we're in the midst of that already, given how US equities have panned out the last 2 days. Or do you start digging out contra bets right now? Do you begin to already look at IT, which has actually been the best performer? I mean, the likes of TCS are already at their 52-week highs. And maybe look at pharma. What is it as an investor do you do? Do you go back to the drawing board and now, begin cashing out of names where you have made those 40, 50 obscene sort of returns in the year gone by?
So let's get some facts out of the way. So the US correction that you're referring to has meant that the Dow Jones is down 2% from its all-time high levels. And that's hardly a correction for anything worth a correction. So let's get that fact over there. The second fact I think we should understand here is that while we all talk about rising share prices in India and some quarters even alluding to a possible bubble, nothing in this stock market rally, or I should say very little about this stock market rally is actually India-centric. It's largely a global bull market. Stock prices are going up everywhere. I mean, this year, India has underperformed emerging markets. Emerging markets are up double digits. I mean, China is up a lot more than double digits. So the Nifty has actually done nothing this year compared to what markets around the world have been doing. And not just this year, but for the past several years. Last year the Nifty was up 30-odd% and 35%, I think, to be precise. And that was a middling performer. We track over 140 indices globally. The best performing index globally was actually the small cap index of India, which was up 65%. And the second best performing index was MSCI China. So if there was any sort of exuberance, it was actually in the small and mid cap space. And very appropriately, that is correcting this year. I'm not surprised by it. We've been worried about broad market valuations. Market cap to GDP was nudging towards 100%. I think it peaked at about 90 to 93%. Now it has come down from there. And it makes sense, I think, for the broader market to correct. This doesn't necessarily apply to the Nifty, but as far as the market's next move is concerned, and this is a question that we keep asking ourselves: where is the next 500 Nifty move, 500-point Nifty move? I think that primarily depends on what the US does, and it's not going to be an India-centric call unless something untoward happens in the budget. So some nasty surprise comes, which then causes the Nifty to correct on its own. Otherwise, I think it's more or less global for now. I expect India to outperform, but that also is contingent on oil prices. So, to answer your question on what investors should do, I mean, my view as far as bulk of your viewers is concerned is continue to invest in a systematic fashion. Do not try to time the market. Let the professionals do that. Come in every month, put a percentage of your income into stocks. We are in a long-term bull market, which of course will have corrections, and some of them will be nasty corrections. We had one nasty correction at the end of 2016 when demonetization was announced. We had one in February 16. We didn't really have any big correction last year. So the market is overdue for a correction, and it could happen anytime. But so far as you're investing systematically, I think you can withstand that. Though I would opine that mid caps may go down a bit more before they settle down and get ready for the next move. But I think, as I said, we are in a 3 to 5 year bull market. We're at the beginning of a new growth cycle, a beginning of a new profit cycle. But of course, that doesn't mean that share prices don't correct. And just one final point on this. in this earnings season thus far, the companies that have reported have beaten sell side estimates in 3 out of 4 cases. But stock prices have gone up only in 1 out of 3 cases, which tells you that the market was already expecting this. So, while the growth cycle is turning, it's always a function of what's priced in. And as far as mid caps and small caps were concerned, I think they had gotten a little bit out of hand, and now they're appropriately correcting.
Well, wonderful, points to them, and always a pleasure and a delight to have you on it. Certainly hope to see much more of you going forward. That's Ridham Desai, Head of India Equity Research and India Strategist with Morgan Stanley. Well, he's making a very valid point here that the small cap index last year was, the Indian small cap index last year was up more than 65%. That's unheard of. Any index going up by 65%. And when that typically happens for 2 or 3 years in a row, then you could be in for a bout of profit booking or a selling. So I'm not surprised at all with this entire meltdown is a very strong word, but the correction or the severity with which some of the small cap stocks have fallen. You cannot have a situation when markets are turning around, economy is on a boom period, a new growth and a profit cycle has started, and small cap stocks are trading at P multiples which are higher than large cap stocks.